We are in the midst of the biggest financial opportunity of our lifetimes. Learning basic technical analysis can help you make sure that you do not miss out on this opportunity. If you want to learn TA and become a profitable trader in this market, we have built the ultimate training course to give you the skills to do just that. No experience or prior knowledge is required. Our 6-chapter course is designed to teach brand new traders the ins and outs of how to become profitable and take advantage of the biggest financial opportunity of our lifetimes. 6 chapters, 44 videos. You can get through these at your own pace. And if you watched everyone back to back, you could be done in under 1 day. Each chapter has its own PDF text, trading journal, templates, calculators, and a ton more other useful trading tools.
But wait, there's more.
For the next 2 weeks, we're offering the course for 50% off. And with your purchase of the course, you get 3 months in the Telegram group that gives you access to our trade setups for Bitcoin, Ethereum, and a number of other altcoins. Your membership gives you access to all of the exclusive trading resources on our website. This includes trading tools, cheat sheets, textbooks, discounted offers, indicators, fillable PDFs, and a ton more. You also get access to members-only live streams where we answer your TA questions on Bitcoin, Ethereum, and a number of other altcoins. So get on over to the website, 3candlecollective.com, and sign up right now.
Self-destruct sequence activated. 3, 2, 1.
Is this your homework, Larry?
Just ask him about the car, man.
Is this yours, Larry? Is this your homework, Larry?
Is that your car out front?
Is this your homework, Larry?
We know it's his fucking homework. Where's the fucking money, you little brat?
Market trends are among the most fundamental aspects of financial markets. We can define a market trend as the overall direction that an asset or a market is going, and as such, market trends are closely watched by both technical analysis and fundamental analysis. Analysts. Bull markets tend to be relatively straightforward though, as they can allow for some of the easiest trading and investment strategies, and even inexperienced traders might do well in a favorable bull market with favorable conditions. Now, with that said, it is also crucial to understand how markets move in cycles. So, what should you know about bull markets? How can traders take advantage of said bull markets? We're going to explain that in this lesson. Now, what is a bull market? A bull market or a bull run is a state of a financial market where prices are rising. The term bull market is often used in the context of the stock market. However, it can be used in any financial market, including Forex, bonds, commodities, real estate, and cryptocurrencies. Now, besides, a bull market may also refer to a specific asset such as Bitcoin, Ethereum, or even Cardano or DOT or anything like that. It could even refer to a sector such as utility tokens, privacy coins, or biotech stocks. So the range really varies. Now, you might have heard traders from Wall Street use the terms bullish and bearish. When a trader says they are bullish on a market, it means that they expect prices to rise. When they are bearish, they expect prices to decline. Being bullish can often mean that they are also long on the market, meaning they have interest in the market, though that may not necessarily be the case. Being bullish may not necessarily mean that a long trade opportunity is present right now, just that prices are rising and are expected to continue to rise. It's also worth noting that a bull market doesn't mean that prices don't fall or fluctuate. This is why it's more sensible to consider bull markets on larger time frames. In this sense, bull markets will contain periods of decline or consolidation without breaking the major market trend. Take a look at the Bitcoin chart here. While there are periods of decline and a few violent market crashes, it's been in a major uptrend ever since the very beginning. So in this sense, the definition of a bull market depends on what time frame we're talking about. Generally, when we're using the term bull market, we're talking about a time frame of months or years. As with other market analysis techniques, higher time frame trends will have more validity than those of lower time frames. And as such, there may be prolonged periods of decline in a high time frame bull market. These counter trend price movements have a notoriety for being especially volatile, though this can vary greatly. Now, bull market examples. Some of the most well-known examples of bull markets come from the stock market. These are the times when stock prices and market indexes such as the NASDAQ are continuously rising. As far as the global economy is concerned, it fluctuates between bull and bear markets. These economic cycles can last for years, even decades. Okay, so bull market versus bear market. What's the difference? These are opposite concepts, so the difference isn't too tough to guess what it is. Prices are continuously going up in a bull market, and prices are continuously going down in a bear market. This also results in differences in how it may be best to trade them. In a bull market, traders and investors will generally be wanting to go long, and in a bear market, they either want to be short or stay in cash or a stable coin like USDT. Staying in cash may also mean shorting the market since they are expecting prices to decline. The main difference is that staying in cash is much more about preserving capital, while shorting is about profiting off the decline in assets prices. But if you sell an asset expecting to buy it back at a lower price, you're essentially in a short position, even if you're not directly profiting from the drop. One additional thing to consider is fees. So staying in stable coins will likely not incur any fees, as there typically isn't cost to holding custody of your own stable coins. However, many short positions will require a funding fee or interest rate to keep the position open. This is why quarterly futures may be ideal for long-term short positions, as there are no funding fees associated with them. So how can traders take advantage of bull markets? Well, the main idea behind trading bull markets is relatively simple. Prices are going up, so going long and buying dips is generally a reasonable strategy. This is why the buy and hold strategy and dollar cost averaging. Now, there's a saying that goes like this: the trend is your friend until the end. And that just means that it makes sense to trade with the direction of the market trend. At the same time, no trend will last forever, and the same strategy may not perform well in other parts of a market cycle. So the only certainty is that markets can and will change. As we've seen with this whole pandemic, multi-year bull markets can be wiped out in a matter of weeks. Naturally, most investors will be bullish in a bull market. This makes sense since prices are going up, so the overall sentiment should also be bullish. However, even during bull markets, some investors will be bearish. If their trading strategy accommodates for it, they may even be successful with short-term bearish as shorting. Now, some traders will try to short the recent highs in a bull market. However, these are advanced strategies and are generally more suitable for professional traders. As a less experienced trader, it is usually more sensible to trade according to the trend. Many investors get trapped trying to short bull markets, and after all, stepping in front of a raging bull or a locomotive can be a pretty damn dangerous undertaking. All right, so as we've discussed, we know what a bull market is. We know how traders may approach trading in said bull markets, and typically the most straightforward trading strategy in any market trend is to follow the direction of said overall trend. As such, bull markets may present good trading opportunities, even for beginners or first-time investors. However, it's always essential to manage your risk and keep learning how to avoid mistakes as much as possible. Capital preservation and risk management, that is the main focus of this entire course. Again, you've been given a PDF text that you should have reviewed prior to watching this lesson. And moving forward, it's highly recommended that you do review each text before moving into the lesson. That way you have a bit of a understanding of the lesson before you head into it, so you're not surprised. If that makes sense. Okay, so technical analysis. Now, the whole reason for this course is to familiarize you with technical analysis. And as we spoke about in the previous lesson, we are in a Bitcoin bull market. And to take advantage of the opportunities this bull market brings, you must become proficient in technical analysis. Now, it's often referred to as charting. It's a type of analysis that aims to predict future market behavior based on previous action and volume data. You should know the difference between technical analysis and fundamental analysis. And if you're not sure, please refer to the PDF handout so you can compare and contrast the two. But for the sake of time, we will continue here. Now, as mentioned, TA is basically the study of an asset's current and previous prices. The main underlying assumption of TA is that fluctuations in the price of an asset are not random and generally evolve into identifiable trends over time. At its core, TA is the analysis of the market forces of supply and demand, which are a representation of the overall market sentiment. In other terms, price of an asset is a reflection of the opposing selling and buying forces, and these forces are closely related to the emotions of traders and investors, essentially fear and greed. It's an important indicator which I'm sure that you've heard of if you have been in this space for any significant amount of time. Now, in order to examine prices and eventually spot favorable trade opportunities, traders utilize a variety of charting tools known as indicators. Technical analysis indicators can help traders identify existing trends and also provide insightful information into trends that may emerge in the future. Now, since TA indicators are fallible, some traders make use of multiple indicators as a way of reducing risk or finding what's called confluence. Confluence is essentially the agreement of certain technical analyses that will help you establish a case for an idea, either bullish or bearish. So if you're looking for bullish confluence, you're looking for TA indicators or a technical analysis charting idea that shows that a bullish case is possible. The same but in reverse. If you're looking for a bearish case, you will look for as much bearish confluence as possible. Bearish divergences, hidden bearish divergences, downtrend, trend breaks, support breaks, resistance fails. Everything you can that adds confluence to an idea will make your idea that much more sound. So some common TA indicators. Now, traders will use a variety of indicators and metrics to try to determine market trends based on charts and historical price action. Among them, one of them being the most important, are moving averages.
Moving average is a technical indicator that refers to an average price for a particular trading instrument over a specified period. Moving averages are used by investors and traders to track and identify trends by smoothing normal day-to-day price fluctuations. There are various moving average lengths. A 20-day moving average, for example, calculates the average price of a specific instrument over the past 20 days. A 20-day moving average can be seen here as the blue line. Investors can use this line as a support or resistance level indicator and base trades around it. Moving averages are calculated by adding up the previous X number of periods and dividing that sum by the total number of periods. For example, a 5-day moving average is calculated by totaling the previous 5 days' price data and dividing by 5, a simple arithmetic mean. Each time a new period occurs, the moving average moves forward, dropping the first data point and adding the newest one. As a technical indicator, a moving average appears as a smooth, curving line that provides a visual representation of a stock's longer-term trend. Faster moving averages with shorter look-back periods are choppier. Slower moving averages with longer look-back periods are smoother.
Now, there are two different types of moving averages. There's actually more, but for the sake of this course, there are two. Simple moving averages, which are just as they say, the simple average of price over a given amount of time. And then the exponential moving average. It's a modified version of the SMA, or the simple moving average, that weighs recent closing prices more heavily than older ones. If you're looking to use a moving average in a recently trending market, you would want to use an exponential moving averages. If you are looking for a moving average point in a trending market that's been trending the same way for a significant amount of time, then it would be appropriate to use simple moving average. All right. Another commonly used indicator is something that we will go through in depth in this course, primarily in Chapter 3, is the relative strength index.
So the relative strength index has a standard 14 periods on your traditional charting softwares. You can go ahead and change those things. I prefer the standard 14 periods. And then when you hear the relative strength index, we are not referring to relative strength. The relative strength index, RSI for short, is simply a momentum indicator. Relative strength is one asset compared to another. So if financials are outperforming the S&P 500, financials are showing relative strength. If healthcare is underperforming the S&P 500, healthcare is showing relative weakness. Okay? So when we talk about RSI, the relative strength index, we are simply referring to a momentum indicator. And then when you hear me say period, if we're looking at a weekly chart, that means we're using a 14-week RSI. And if we're looking at a daily chart, that means we're looking at a 14-day RSI. And the indicator goes from 0 to 100. So all that means is that it's an oscillator. So the RSI is a momentum oscillator that goes between 0 and 100. Traditionally, 30 is giving you an oversold reading and 70 is giving you an overbought reading.
You might have heard of Bollinger Bands. Bollinger Bands are an oscillator type that is they're pretty popular. They help let you know when it's time to buy and let you know when it's time to sell.
Bollinger Bands were created by John Bollinger in the 1980s as a method for traders to identify extreme short-term prices in a security. The indicator is created by plotting the average of a predetermined number of prices along with two trading bands above and below. The outer bands are created by simply adding and subtracting one standard deviation from the moving average. Standard deviation is used to create this indicator because it is a common measure of volatility. Under normal conditions, traders will nearly always find the price of a security to trade within the bands. The bands will expand and contract as the price action of the security being studied becomes volatile, expansion, or becomes bound in a tight trading range, contraction. One of the main concepts to understand when using Bollinger Bands is that periods of low volatility generally tend to be followed by periods of high volatility and vice versa. In other words, if a trader notices that the Bollinger Bands start to pinch together, then there is a reasonable chance that volatility will increase and a trading opportunity will soon appear. Another method of using Bollinger Bands is to note when the price of a security moves beyond the upper or lower barriers. When the price moves above the upper band, prices are thought to be overbought and could be due for a pullback. Conversely, a move below the lower band suggests that the price is oversold, triggering a buy signal. Bollinger Bands have become a top trading tool for a good reason. Identifying prices that move beyond the bands helps traders take advantage of unjustifiably high or low prices. It is important for traders to monitor shifts in volatility, and few methods accomplish this better than Bollinger Bands.
Another one that we will discuss in this course is the stochastic RSI. It's calculated by applying a mathematical formula to the regular RSI. Another popular example of an indicator is the moving average convergence divergence indicator, or the MACD, another one we will go over in this course.
MACD is made up of two moving averages represented by these two lines here. They have different time periods, so they're not exactly the same, and the difference between them is represented by the individual red lines. What does the MACD help you identify? It helps identify points in the price chart where the trend might be accelerating, when these two lines cross. So there's two indications of that on this chart, here and here. A lot of traders use this for an entry signal.
So trading signals, while indicators are useful for identifying general trends, they can also be used to provide insight into potential entry and exit positions or buy and sell signals. These signals may be generated when specific events occur in an indicator's chart. For example, when the RSI produces a reading of 70 or more, it could suggest that the market is operating under overbought conditions, and the same logic applies to the RSI when it declines under 30 or less, which generally is perceived as a signal for oversold conditions. So, if the market is oversold, what would be a good thing for you to consider doing in that market? You'd want to buy. If it's overbought, you'd want to sell. So overbought means it's been trending probably to the upside for quite some time and a correction is imminent. So the market is overbought. So you'll look to be exiting positions. If a market has been moving to the downside for a significant amount of time, chances are it is oversold. So you'd be looking to buy and enter into position there. Now, as previously discussed, the trading signals provided by technical analysis are not always accurate, and there's a considerable amount of noise or false signals produced by indicators. This is especially concerning within the crypto markets, which are way smaller than traditional markets and as such much more volatile. Now, although extensively used in all sorts of markets, TA is seen by many specialists as controversial and sometimes unreliable, and is often referred to as a self-fulfilling prophecy. I'm sure you will hear that quite a bit through your trading career, and in a way it's mostly true. Such a term is used to describe events that only happen because a large number of people assume that they would happen. So TA is not necessarily a strict defined set of rules, but rather a variety of rules that can be used in combination and also have exceptions to those rules in certain times. So the basis of this course is I will teach you the basic rules that just about every trader follows when doing technical analysis. And it's my hope that through time and as you learn how this market functions, you will understand when exceptions to those rules will be necessary. Now, critics argue that in the context of financial markets, if a large number of traders and investors rely on the same types of indicators such as support and resistance, that these indicators work better just because of the self-fulfilling prophecy idea. Now, on the other hand, many technical analysis supporters argue that each chartist has a particular way of analyzing the charts and use the many indicators available. This would imply that it is virtually impossible for a large number of traders to use the same particular strategy. In a sense, that's correct. In a sense, it's not. If we're using the same rules for drawing trend lines and finding resistance and support, then it should make sense that we should come to the same conclusion if we are following the same rules. Now, finding where these rules break down, and there may be exceptions to said rules, is really the talent of being a good chartist and trader. Now, fundamental analysis versus technical analysis, we won't really go into this right now, but fundamentals are basically what you hear in the news. You hear about mass adoption, that's strong fundamentals analysis that suggests a bullish case for Bitcoin. Technical analysis is when you put it on the chart like we just discussed. Finding the potential for a bullish case, how high the market can climb in said amount of time, when we might see dumps. Even though we are in a strongly trending market, a very bullish market, there are going to be drops in prices. Using technical analysis to find those drops in prices is what will really help you out. Now, besides the criticisms and the long-standing controversial debate about which method is better, a combination of both technical analysis and fundamental analysis approaches is considered by many as a more rational choice. Now, while fundamental analysis usually relates to long-term investment strategies, TA may provide insightful information in the short-term bear markets, into short-term market conditions, which may be useful for both traders and investors, for instance, when trying to determine favorable entry and exit points. So the reason why you're here, Bitcoin is in a bull market. Fundamentals are strong as hell for Bitcoin right now. Knowing when to buy into that market, you're going to use technical analysis. The skills you're going to learn in this course will let you know the best and worst times to get in and out of this market. All right, welcome to the 3 Candle Collective Technical Analysis Basic Training course. This is the Tradingview section of this course. You will find this information in chapter 1 of the PDF that I sent you. So if you forget anything that I go through in this video, you can always just reference this handy dandy little PDF that looks like this that comes with every chapter lesson. All right, so what are we going to talk about in this Tradingview tutorial? We're going to go over how to set up your chart, how to customize your chart, how to select and use certain drawing tools, how to set up alerts, insert indicators and customize them, and then we will go over creating your own watch list. So let's get going. So when you first sign into TradingView, your chart is going to look like this. This is the Bitcoin 2-hour chart. Your time frames will be up here in this corner. The asset that you're looking for will be in this corner. So the chart that we always use in the group for Bitcoin, just for your reference, just type in BTC USD and you'll get the first one on top here. It is the Bitstamp chart. This is the chart that we typically use for really the main reason is that it has the most data. So depending on how long certain exchanges have held Bitcoin, all of these charts are going to be that specific exchange data. So what do I mean by that? So we have the Bitstamp Bitcoin. Say we want to look at the Binance BTC USD. Okay, so or we can just look at ByBit. Let's go to ByBit. So you can see this ByBit chart. Let's zoom out to the daily. This ByBit chart only goes back to November of 2018. And if we go back to the Bitstamp chart, you can see that this goes back significantly further. Just looking at it from here, you can see it goes all the way back to 2011. So that's why we use the Bitstamp chart versus any other one. When you first open up your chart, it's going to be on auto. I recommend shutting that off. And when you're trading or charting cryptocurrencies, it's always a great idea to use the log scale chart. All right, so top left, these are your time frames. These are your basic time frames. If you have a pro membership or better, you can adjust the time frames that you want to look at. So typically I keep, we'll go out here. So we'll start out, oops. So I always keep a 1 week chart up here, and that is always there. The 1 month chart is there, and that is always there. So if you want to look for a custom time frame, what you'll do is you'll say 3, and then it'll give you the ability to pick minutes, hours, days, weeks, months, or a range. The best thing to do here, so we want to find a 3-month chart, right? And we'll just add that really quick. So we'll just add that really quick, and you see it pops up right here under days. So if we click on that, it'll take us to the Bitcoin 3-month chart, right? Pretty easy. So you might notice that some charts you see have a bunch of different time frames up here. So how to select quick reference time frames, you will just go into this menu right up here, and you'll just click on the little star. That will give you the time frames that you can reference pretty quickly. My favorite time frames are the 1, 2, and 3 and 4 hour. 8-hour, 12-hour, and then the daily. And then you may see sometimes I will post charts with 30-minute time frames. That will be to let you guys know that we're nearing a time where we might look to enter or take profit in a trade. So that's the time frames. And then the next one over here, let's actually go back to the daily chart. Okay. So the next one over here, you can choose your type of chart that you want to look at. You can use regular bars, you can use hollow candles, you can use Heikin Ashi candles, which is what I use in every chart that I post, and I recommend that you use them through this course as well. You can use regular candles. We'll go ahead and select Heikin Ashi, and you can also pick a line chart, an area chart, baseline chart. You can use what are called Renko candles, line break candles. And these we won't use in the trading group really at all. Occasionally I will use Renko candles when I'm looking at indexes, but for the purpose of this tutorial, the only candle that you really need to pay attention to are the Heikin Ashi candles. So make sure those are selected. Okay, so we're setting up our chart. We've got our symbol here. We've got our time frame selected. We've got our candles. They're selected Heikin Ashi candles, okay? And then the next thing we are going to do, if we want to go ahead and save this chart, so you're going to hit rename, and I'm going to name this one Tradingview Tutorial. Boom, Tradingview Tutorial is saved. Now, you might also notice that a lot of my charts don't look the same, or excuse me, you might notice that a lot of my charts might look different or they're customized. How I do that. So what you're going to do is you want to click on this little gear in the top right, and this will give you a whole bunch of more options. So the first one you're going to want to click on, especially if you are using Heikin Ashi candles, which I always do. And if you're in this course, I recommend using them through the duration of this course. You're going to click on show real prices on price scale instead of Heikin Ashi prices. Now, why you want to click on that, that will be something I teach later in the course. You'll actually learn that in one of the coming video lessons. And then you can do a number of different things here. You can add high and low price lines. You can add, different things if you're looking to trade stocks. So you can use the information you learn in this course to trade stocks. It's not just for cryptocurrencies. And you can also pick your time frame. So typically things are put on UTC, but I'm here in Los Angeles. I like to see times that correspond to LA times. So I click that. The status line, this really just shows you everything you'll see on the right here. Scales. Scales is just another number of options that you can pick here, just really what you want your chart to look like. So it's really what appears on your chart. And then you're going to go to appearance. So appearance, you can adjust this any way you like, whatever you feel more comfortable adjusting it to. But I get rid of the vertical and horizontal lines just because I really don't like them on my chart. And I change my crosshair from gray to white, and I use a dotted line on the smallest thickness setting. You can turn your watermark on or off. All of that, all a watermark is just this background information back here to let you know what chart it is you're looking at. Or if you go to take a snapshot of your chart, whoever's looking at your chart, they can see quickly what time frame and what asset this chart is for. Trading, this really goes into more of the features available if you're trading stocks. So if you use a broker through this website, Tradingview, this will give you this will allow you to interact with different brokers that are available through this site. Events, so you can post certain events. Again, this is more or less for stock trading, not necessarily cryptocurrencies, so we will not really go into that. If you want to save your chart setup, so you can go here under template and click save as, and it'll save this chart setup, and we'll call this one Tradingview Tutorial. Okay, easy peasy. So our chart is saved. Our chart looks the way we want it. Again, if you go back in here, you can change the color of these candles, whatever you feel comfortable. I like to use green and red or variations of thereof. But whatever you like, whatever floats your boat. Okay, so if you are using a premium package or better, you can actually add numbers of charts to your chart. So we can add this into, put this into 3 screens and chart 3 different assets. But you really don't need to worry about that at this point in time. Keeping 1 screen is just fine for now. So if you want to go full screen, that's this button here. We won't click on that. If you want to take a picture of your chart. So if you earn privileges to post in the group, this is how you will post your chart. You'll say, take a snapshot, and this will pop up, this little window. All you have to do is copy. And then if you paste this somewhere, so if we open up another window, paste this, it'll take us to what that chart looks like at that point in time. Okay, if you want to publish, so if you're coming along in your trading and you feel like you have something to contribute to the community, you can go ahead and publish your chart ideas, and these will show up in the ideas section, something that we'll go over a little later, but for the purposes of this lesson, you do not need to know any of that. Okay, so let's start on the left-hand side here. So this is the type of cursor you're using. I typically like to leave it where it is, right here on this X. And then this menu, this is your first drawing tools menu. So you have your trend line, your info line, something we don't typically use. Anchored VWAP, we will use that, but don't worry about that for now. You can do a cross line. You can use arrows. Horizontal rays are very useful. So all these are, so horizontal rays do that. So it's from the point that you click all the way to the right-hand scale side, and it does list you a price. Now, when you do put a drawing on your chart, you will get this little menu that will pop up. This menu is where you change your thickness of your line. So we can go thin to fat. Whether you want a dotted, dashed, or solid line, okay? And then you can actually change the style of said drawing. You can add text to a lot of these. You can, you know, if you're looking for some precision in your charting, you can actually add the price at which these horizontal rays or trend lines are there, and you can change the visibility. So you can leave these drawings on your chart for a certain amount of time, in this menu here. So that's all that is there. You can add an alert. So say you post this horizontal ray and you want to add an alert if price crosses above that horizontal ray. What you'll do is you'll click on the alert. Okay, it says condition Bitcoin Heikin-Ashi candles crossing. What we'd want to do is change that to crossing up the horizontal ray once per bar, and then you can change how long this alert will stay active for. Okay, and then you can also have the option to notify you on the app. If you have the mobile app for your phone, show a pop-up on your desktop, send you an email. So that would be an email that you set up in your settings when you first join. You can send a webhook email or URL. We won't get into that, but that is how I send alerts to the Telegram groups. And you can have it play a sound. These sounds are extremely annoying, fair warning, but they are that way on purpose. You can send an email text, so you can have it set up so it sends a text to your phone. You can name the alert. So we'll say Tradingview tutorial alert. Okay, and then you say the message. So when you get the pop-up or notify on app, you will get the message alert, and this is what you'll see. It'll say the time frame of the chart, the type of chart, so Bitcoin 1 day Heikin-Ashi crossing up horizontal ray, and you know you should know the price at which you put the horizontal ray. So that's how you set up a basic alert. That's the alert that we have set there. And to view the alerts that you have set, you will click on this little clock here, and usually it stays in order. So that alert will be this alert here. If I made a mistake or need to go back and edit it, I'll click on the little gear here, and I'll edit it and save. But I'm going to delete this alert because this will actually end up being sent to the trading group if I leave it live. Okay, so that is where we are at there. So we have this top menu basically taken care of. Your TradingView charts will always appear here. So if you want to load another saved chart, you'll click on load chart, or you can make a brand new chart. You can rename it, make a copy. If you want to share the chart with someone, this is where you will click share. Or if you just want to save it, you can do one of two things. You can hit Control S, or you can just click on this TradingView thing here. If you make a mistake, so say you post, say you post a horizontal ray and you don't want that there, it was an accident, you can hit this back button, or you can do the same thing by hitting Command Z. So if you forget all of these keyboard shortcuts, no big deal. I will remind you guys of them later in the episode and give you a cheat sheet. So indicator templates, something we won't use. Fundamental metrics for stocks, something we won't use. Indicators, something we absolutely will use. So this is what your indicators and strategies looks like. So if you're looking for an indicator, you'll click on that F of X box. You will type in the name of a indicator. So we're looking for the relative strength index. Boom, there it is. It's already in my favorites. So if you want to add this to your favorites, you'll highlight this star and it will save in your favorites. Okay. One thing I want to mention is I'm going to send you invite only scripts. So when you click on that F of X and it brings up this window, you're going to click here on invite only scripts. And this is where you will see the invites for the scripts that I had sent you. So when I reference the invite only scripts, this is where they will be. Okay. Okay, so we brought up our RSI. So let's bring up all of the indicators that we are typically going to use. Okay, so we're going to look for the MACD. Boom, first one, make sure you click the star and add that to your favorites. Okay, the next one, stochastic. Stochastic RSI. We're going to use that one. So make sure you add that one by clicking on the star to add it to your chart. For now, it's best if you just do not go looking or trying to use all of the other indicators. It's a lot of information and you may just end up confusing yourself. Okay, so this is what our menu looks like right now. If we double click up here, you can see that it takes away the other indicators and brings us back to this full chart. So in this menu, we went over all of the drawings that we have here. You can get in there and experiment with those on your own. Here is where you will find a lot of the drawing tools that I do use in the charts I post in the trading group. The number one tool in the trading group that I use is the Fibonacci retracement tool. This tool is very, very useful and something that I will show you how to use later in the course. I'll show you how to use these later in the course, but this is where all of these tools are. So if you click on Fibonacci retracement and you use this tool, say we just want to find a retracement down here. Okay, so that's how that works. If you want to customize the Fibonacci retracement, again, you can click on the gear and it will look like this and you can adjust that any way you want. If you want to delete it, just hit the remove button there. Okay, text, this is where you'll add text. This is where you will use certain tools that will help you draw triangles and different patterns that we will discuss throughout the duration of this course. To help you find your risk reward ratio, something I will teach you later on in the course. This is where you will find this. So in this menu, you will find where you put your long positions and short positions, and how to set those up is something we will go on to later in the course. Now you have this handy dandy measure ruler here. It can give you a price range. It can give you time range. It gives you really both at the same time. Another way to access that is to just hold the shift button and then click wherever you want to start to measure. Your zoom is here. Your magnet, now this can be quite annoying, but it can also be quite useful. How this works is, say you're using your magnet and you want to draw a trend line across the top here. What it does is it makes the trend line just stick to the top of the wick immediately. Okay, so sometimes that helps with chart drawing, sometimes it can actually impede it. This will lock your chart, so this is something that you should definitely remember how to use, because as you accumulate drawings on your chart, if they're not locked, they can be easily moved. Okay, so if you lock the chart, you cannot move these drawings. Unlock the chart, drawing moves. Okay, chart drawings should be locked at all times. It really can become a pain in the butt when you're trying to navigate your chart. But every time you click to move the chart, you click on a drawing and it moves instead of your chart. All right, so we've got our left side menu basically taken care of. This little eye, so this little eye is, say, if you have a bunch of chart drawings and you just want to pull those chart drawings away for a second, you click on the eye and it hides all of your chart drawings. Okay, say you want to start your chart completely over, get rid of all of your drawings. You will click on this little garbage can and it will completely erase your chart. All right, so just to review, this is where we will name, save, and load our charts. This is where we will take a picture. This is where we will go backwards. You can also do Command Z. You can use a rewind function, but the rewind function must only be used with regular candles. How this works is, say you want to practice trading a pattern, okay? Right? And you can go back in time. So that red line takes you back to the point in time at which you want to start. And then you'll push the play on this little menu bar down here and it will just go further in time. So this is something you can use to help practice and back test certain trading strategies. All right, so let's go back to Heiken Ashi. Yep. Cannot go in that mode from there. Okay, so on the right hand side, so top button, this will be your watch list, okay? So this is something we are going to use, and in one of the next lessons, I'm actually going to help you set up your watch list. It's very, very easy. Typically, you will have your one symbol in there that you're looking at currently, and to add more, you will just click on the add button, and you can search in any other symbol that you want. Okay, the next one is your alerts panel to let you know all of the alerts that you have set. This one is the headlines or the news for the current asset that you are looking at. So all of these are Bitcoin news articles, and this can be pretty useful, honestly. This is pretty good. This is your data window. So this will tell you all of the data for any of the indicators that you have on the chart, the high, low, close of a certain time frame. So you can, scroll over that or hover over that and it'll tell you that information. But anything that you have connected to this chart as far as data goes, I mean, indicators and any strategy things that produce, data sets, you'll see those here. This little guy, so this gives you basically just news from around the investing world. A lot of this is exchanged for stocks and certain things. We don't really typically use this menu for much. This is your economic calendar. So this will be more for stocks. Again, we do have a group calendar that keeps us updated on all of the important dates that are coming up for crypto. So if you do not have an invite for that subscription, please let me know and I will shoot that over to you as soon as possible. Ideas. So this is pretty cool. So this little light bulb will show you all of your ideas. So in the previous part of this lesson, we did talk about clicking on this publish button. So every idea that you published will show up here. This is your, not your, but the chat. So there are a bunch of chat groups for different assets. There's some pretty interesting stuff in there. There's some pretty interesting people. Be very, very careful of scams and people trying to sell you things that you do not need. This is your direct message panel. So if people message you directly through Tradingview, you can check them here. This is the ideas stream panel. So this can be pretty useful. So if you're looking for ideas on whatever asset it is you're looking at, in this case, it's Bitcoin, the community around Tradingview will publish their ideas and they will show up in here as well. Now, if you follow certain people, they will typically be the only ones to show up in here, but you can change these settings here, right? So you can change those to show all ideas, show ideas of followed users only, and show my ideas. Now this will pop up on the screen, which can be kind of annoying. So if we take those off, we'll just get rid of that. It'll actually click on there. So we'll just hide those. So you right click and I clicked hide. Okay, so this is a streams section. This really just started, so we won't, any stream I do, you will have an invite, so you don't need to worry about that. This is your notifications tab. So when people interact with your publications, you will get a notification here. This is your trading order panel. We do not use this for crypto because you do not have the ability to trade directly from your TradingView chart to most crypto exchanges. And then this guy, this is your market buys and sells. This is how you track your orders. And this can be pretty useful as well. This is a object tree. So this is very, very useful. So say you're drawing a pattern today, right? And all of these lines on your chart will start to accumulate. What you want to do is click on one of your drawings and then click on this folder and create a folder. And you can double click on that folder to change the name. And we'll just say this is 22 January 21. Okay, so all of these drawings then will be in this folder. And I can then lock that folder so the chart drawings can't be moved, see? Or I can just hide those specific drawings. Okay, so if we add some more, right, and this chart drawing will not be in that group, but we can still hide this group and that chart drawing will still stay there. Okay, so that's pretty easy. Remember, the chart drawings is very, or the object tree is very useful. One last interesting and useful, very useful thing on your TradingView chart. If you go to Crypto Screener, it will give you the ability to screen through every single crypto that TradingView has data on, which is pretty awesome. And you can filter these results a number of different ways. So this will prove very, very useful, especially as altcoin season nears and we start looking for an altcoin boom. This will help us catch overbought and oversold bounces. All right, guys, that's it for this TradingView tutorial. Make sure you set up your chart similarly to mine. Use the Heikin-Ashi candles. Make sure you're using a log scale chart only. And that's really the only requirements I have. You may like using a dark chart a bit better than a light chart. Again, how you would change that, click on the gear in the top right, click on appearance, and then you can say your background here. Okay, so you can change that from a solid to a gradient. And you can do all kinds of neat things there. But that's it, guys. Great job. On to the next lesson. In this lesson, we're going to talk about the different order types. Just to preface all of this, a market order is an instruction to buy or sell immediately at the current market's price. A limit order is an instruction to wait until the price hits a limit before being executed. Now, if you understand this, you can go ahead and skip this lesson. But if you do not, make sure you pay attention and follow along with the PDF text because this is a very important chapter to have a grasp of. You need to know what the different types of orders are before you start executing said orders. So market order versus limit orders. Market orders are orders that you would expect to execute immediately. Essentially, they say that at the current price, do X. Suppose you're on Binance and you want to buy 3 Bitcoin and Bitcoin is trading at $15,000. You're happy paying $45,000 for the coins and don't want to wait for prices to drop lower. So you place a buy market order. Now, who's selling the coins, you might wonder? We need to look at the order book to figure that out. This is where the exchange keeps a big list of limit orders, which are simply orders that aren't executed immediately. These might say something like, at Y price, do X. For the sake of this example, another user might have placed an earlier order telling the exchange to sell 3 Bitcoin when the price hits $15,000. So when you place your market order, the exchange matches it with the book's limit order. Effectively, you haven't created an order. Instead, you've filled an existing one. Removing it from the order book, this makes you a taker because you've taken some of the exchange's liquidity. In the other user's case, however, he or she is a maker because they've added to it. Typically, you enjoy lower fees as a maker because you are providing a benefit to the exchange. We'll talk about the relationship between makers and takers as we move through this lesson. Now, what you need to know about market orders, the basic kinds of market orders are buy and sell ones. You instruct the exchange to make a transaction at the best available price, and you should know that the best available price isn't always the current value displayed. It depends on the order book, so you could end up executing your trade at a slightly different rate. Now, market orders are good for instant or near instant transactions, but that's about it. Fees incurred from slippage and the exchange mean that the same trade would have been much cheaper if done with a limit order. So from here on out, you need to make sure you understand you should be using limit orders and not market orders. Now, let's move on to some other types of orders. So the simplest orders, again, are buy and sell market orders. Buy and sell limit orders. If you stuck to these though, you'd find yourself with somewhat of a restricted trading experience. Instead, you can build on top of these to take advantage of market conditions, whether in short-term or long-term setups. Order number 1, stop loss orders. This is very important. A stop loss is a type of market order that involves you setting an off-book instruction to sell at a specific price, typically when you're already inside of a trade. As the name might indicate, it's designed to protect you from any significant losses. Ostensibly, this appears to be a limit order since you set a price at which to sell instead of executing at a market price. However, the order isn't added to the order book. The trading platform only converts it into a market order when the trigger price is hit. Stop limit orders. So stop limit orders are a great tool for limiting the losses you can occur on a trade. They're a bit like the stop loss order we just talked about, but they incorporate an extra step. Okay, so OCO orders, or one cancels the other. So one cancels the other, or OCO, is a sophisticated tool that allows you to combine two conditional orders. As soon as one is triggered, the other is canceled. If we take Bitcoin at $10,000, you could use an OCO order to either buy Bitcoin when the price reaches $9,900 or to sell it when the price rises to $11,000. One of these two will be executed first, meaning that the second one is automatically canceled. All right, so time in force. What is time in force? It's another important concept to understand when talking about orders. It's a parameter that you specify when opening a trade, dictating the conditions for its expiration. Good till canceled, or GTC. So GTC is an instruction stipulating that a trade should be kept open until it's either executed or manually canceled. Generally, crypto trading platforms default to this option. In stock markets though, a common alternative to close an order at the end of the trading day is using this good till canceled. Because crypto markets operate 24/7 though, GTC is more prevalent. So another type is immediate or cancel, or IOC. This order stipulates that any part of the order that isn't immediately filled must be canceled. So suppose you submit an order to buy 10 Bitcoin at $10,000, but you can only get 5 at that execution price. In that case, you would purchase those 5 Bitcoin and the rest of the order would be closed. Fill or kill orders, they're either filled immediately or they're canceled or killed. If an order instructed the exchange to buy 10 Bitcoin at $10,000, it would partially fill. If the entire order of 10 Bitcoin isn't immediately available at that price, it will be canceled. So mastering the types of orders is really vital to any good trader's strategy. Now, whether you want to use stop loss orders to limit the potential for loss, or OCO orders to plan for different outcomes simultaneously, being aware of the trading tools available to you is extremely essential. So if you still are a little bit confused on the different types of orders, I highly recommend watching this video again and starting from the beginning, because it's going to be very, very important for your success moving forward. The next concepts that we will be discussing are different types of trading. So you might want to be able to identify what type of trader you are. You might have heard of swing trading. You might have heard of scalp trading. In this lesson, we are going to go over swing trading. Swing trading is honestly what I would recommend, but every trader has their own style, and it's up to you to identify your style of trading. Now, swing trading is commonly used. It can be ideal for beginners. It's relatively convenient, and it's a nice way to express opinions about the market due to the manageable time horizons involved. Now, swing traders are active in most financial markets such as Forex, stocks, and crypto. But swing trading, is it suitable for you? Should you start day trading or should you start swing trading? In this lesson, we're going to go over everything you need to know about swing trading crypto and help you decide if it's the right decision for you.
Swing traders use technical analysis to find stocks that are about to climb or decrease in value. Swing traders don't consider a stock's fundamental or intrinsic value. They're only concerned with trends and patterns. For example, an investor has been studying the price and volume of ABC Corporation's stock and has noticed its MACD has sharply risen above its signal line. She acts quickly, buying shares of ABC, unconcerned about the share's long-term prospects. The investor holds her ABC shares for 4 days, during which time their value climbs 10%. At the end of the 4th day, she sells her shares for a profit. Individuals tend to be the ones who engage in swing trading and take advantage of sudden stock movements. Institutional traders are usually too large to quickly move in and out of positions. Swing trading offers control and flexibility to time markets and take advantage of movements in either direction. But it can be risky. For example, if news breaks about ABC's fraudulent efforts to conceal a product flaw, its stock would suddenly plummet. Swing trading requires careful monitoring to enter and exit a position at the right time.
Now, swing trading is a strategy that involves trying to capture price moves that happen on a short to medium time frame. The idea behind swing trading is to catch market swings that play out over a few days to several weeks. Swing trading strategies work best in trending markets. Let me say that again. Swing trading strategies work best in trending markets. If there's a strong trend on a higher time frame, swing trading opportunities can be plentiful. Swing traders can take advantage of larger price swings. In contrast, swing trading can also be more difficult in a consolidating market. Now, however, if the market is going sideways, it's harder to capture these large price swings. So how do swing traders make money? So as mentioned, swing traders aim to capture price swings that happen from a few days to several weeks. As such, swing traders will hold positions for more time than day traders, but less than buy and hold investors. So swing traders will typically use TA to generate trade ideas, though not necessarily to the same extent as day traders would do. As fundamental events can play out over weeks, swing traders may also use fundamental analysis in their trading framework. Even so, price action, candlestick patterns, chart patterns, support and resistance, and other types of technical indicators are commonly used to identify trade setups. Some of the most common indicators used by swing traders are moving averages, the relative strength index, Bollinger Bands, and the Fibonacci retracement tool. So swing traders will typically look at a medium to high time frame. And why? Medium to high, I mean 4-hour, 12-hour, daily. That's what I mean by medium to high time frame. So why are they looking at these? So a strong uptrend or downtrend has to be confirmed on higher time frames, but they might also look at intraday time frames such as the 1-hour, 4-hour, 12-hour to look for specific entry and lower exit points. These triggers can be a breakout or a pullback on a lower time frame, for example. However, the most important time frame for swing traders is likely the daily chart. Even so, trading and investment strategies can differ substantially between traders. Note that what we've discussed here aren't strict rules, just common examples. So day trading versus swing trading, really, what is the difference? Day traders aim to capitalize on short-term price moves, while swing traders look for much larger moves. It's as simple as that. In effect, day trading is a much more active strategy where traders need to frequently monitor the market, and they don't leave positions open for more than a single day. In contrast, swing traders can take a more passive approach. They can monitor their positions less frequently, as their goal is to profit from price movements that take longer to play out. Since these moves tend to be larger, swing traders can bring in sizable returns from even just a few winning trades. Now, day traders will almost exclusively use technical analysis. Swing traders will use a combo of technical and fundamental analysis, usually with a stronger emphasis on technicals. Now, on the other end of the spectrum, investors may not consider technicals at all and invest solely based on fundamentals, which is something I would never ever recommend. Which one is better for you though? That's what we're trying to figure out here. Are you a day trader or are you a swing trader? Well, where do you see yourself on the spectrum of smaller to larger timeframes, technicals and fundamentals? Answering these questions will really help you find out what trading strategy fits your personality and trading style. Now, you could consider what your strengths are and choose the trading style that best magnifies those strengths. Some prefer to get in and out of positions fast and not having to worry about open positions when they're asleep. Others make better decisions when they have more time to consider all of the possible outcomes and elaborate on their trading plans.
Scalping entails taking profits on small price changes shortly after the trade is entered. It's based on the assumption that most stocks will initially move in the desired direction. Scalpers take as many small profits as possible, and they succeed by making more winning trades than losers. A pure scalper that adopts the craft as her primary style will make hundreds of trades in a day, using mostly 1-minute charts and quote systems. When the market is choppy or locked in a narrow range, a shorter time frame may reveal visible trends and the opportunity to scalp. Any trade that takes profits near the 1-to-1 risk-reward ratio is a scalp. If a trader enters her position for a scalp trade at $20 with a stop at $19.90, the risk is 10 cents. A 1-to-1 risk-reward ratio is reached at $20.10. The first type of scalping is market making. A scalper tries to capitalize on a specific stock spread by simultaneously posting a bid and an offer. This works only on immobile stocks, and it's difficult to use successfully because of competition from market makers. The second type of scalping is buying a large lot of shares and selling for a gain on a very small price movement. The third type sees a trader close a position as soon as the first exit signal nears the 1-to-1 risk-reward ratio. Scalpers must have a strict exit strategy because one large loss can erase many small gains. They need the right tools, such as a live feed. They also need direct access to a broker and the stamina to place many trades.
Now, you could switch between different strategies to see which one produces the best results. You should also do some paper trading or trading with fake money before implementing any strategy into your actual trading plan. Remember, the primary goal of a beginner's trading plan looking for future success is capital preservation. That is the focus of this first chapter, and it should be a focus of your educational goals and trading journey here. So for the most part, you're going to want to take swing trades over scalp trades, mostly because they are the most profitable, especially in a trending market. Margin trading is a method of trading assets using funds provided by a third party. Now, when compared to regular trading accounts, margin accounts allow traders to access greater sums of capital, allowing them to leverage their positions. Essentially, margin trading amplifies trading results so that traders are able to realize profits on successful trades. This ability to expand trading results makes margin trading especially popular in low volatility markets, particularly international forex markets. Still, margin trading is also used in stock, commodity, and cryptocurrency markets. Now, in traditional markets, the borrowed funds are usually provided by an investment broker. In cryptocurrency trading, however, funds are often provided by other traders who earn interest based on market demand for margin funds. Although less common, some cryptocurrency exchanges also provide margin funds to their users. Now, how does trading margin work? So when a margin trade is initiated, the trader will be required to commit a percentage of the total order value. This initial investment is known as the margin, and it is closely related to the concept of leverage. In other words, margin trading accounts are used to create leverage trading, and the leverage describes the ratio of borrowed funds to the margin.
When an investor buys on margin, he or she pays a portion of the stock price, called the margin, and borrows the rest from a stockbroker. The purchased stocks then serve as collateral for the loan. Buying on margin requires a margin account with a broker, who then establishes the account's maintenance margin, which is the minimum amount of equity that must be maintained by the investor in a margin account. An initial investment of at least $2,000 is required for a margin account, though some brokerages require more. This initial deposit is known as the minimum margin. Once the account is opened and operational, you can borrow up to 50% of the purchase price of a stock. If the stock value drops below the maintenance margin, the investor must pay into the account to cover the difference. This is called a margin call. If the investor does not add money quickly enough, the broker can sell the stock without notice to cover the loan. When you sell the stock in a margin account, the proceeds go to your broker against the repayment of the loan, and any remaining profit is yours to keep. Say you want to purchase 100 Sunrise ZR stock with a price of $100, and your broker has a required initial margin of 50% and a maintenance margin of 20%. This means your broker requires you to initially pay $5,000 and maintain the account with a value of no less than 20% of the equity provided. If the Sunrise stock value drops below the 20% maintenance margin, the broker would issue a margin call.
For example, to open a $100,000 trade at a leverage of 10 to 1, a trader would need to commit $10,000 of their capital. Now, naturally, different trading platforms and markets offer a distinct set of rules and leverage rates. In the stock market, for example, a 2 to 1 is a typical ratio, while futures contracts are often traded at a 15 to 1 leverage. In regards to forex brokerages, margin trades are frequently leveraged at a 50 to 1 ratio, but 100 to 1 and 200 to 1 are also used in some cases. Now, when it comes to crypto markets, the ratios are typically ranging from 2 to 1 to 100 to 1, and the trading community often uses the term X, so 1x, 2x, 3x, 5x, 10x, 50x, and so forth. Margin trading can be used to open both long and short positions. A long position reflects an assumption that the market will go up, or the price of the asset will go up, while a short position reflects the opposite. While the margin position is open, the trader's assets act as collateral for the borrowed funds. This is critical for traders to understand, as most brokerages reserve the right to force the sale of these assets in case the market moves against their position above or below a certain threshold. This is known as a liquidation price. For instance, if a trader opens a long leveraged position, they could be margin called when the price drops significantly. A margin call occurs when a trader is required to deposit more funds into their margin account in order to reach the minimum margin trading requirements. If the trader fails to do so, their holdings are automatically liquidated to cover their losses, and typically this occurs when the total value of all of the equities in a margin account, also known as the liquidation margin, drops below the total margin requirements of that particular exchange or broker.
A margin call is issued when the equity in a margin account falls below a certain level. In the United States, this level is set by the Federal Reserve Board Regulation T. Many brokerages have their own margin requirements, known as house requirements, usually with maintenance levels of 30 to 40%. For example, Joe buys 100 shares of Heisenberg Pharmaceuticals for $20,000, using $10,000 of equity and a $10,000 loan from the broker. After an extremely poor quarter, the market value of Joe's shares drops to $12,000, leaving the margin loan still sitting at $10,000, but the equity at $2,000. If the minimum maintenance margin requirement is 25%, then the equity must not fall below $3,000. In this case, the equity has fallen below the minimum maintenance margin requirement, and the investor would receive a margin call for $1,000. If this demand isn't met, the broker can close out any of his positions to bring the account up to the minimum maintenance amount. In most cases, the broker has the right to decide which securities and assets to sell and may be able to sell the selected assets without consulting the account holder. Thus, it is important to understand the risks associated with trading on margin, as borrowing money to leverage your investments can just as easily magnify your losses as it can with your gains.
Now, some advantages and disadvantages to trading with margin. So the most obvious advantage of trading with margin is the fact that it can result in larger profits due to the greater relative value of the trading position. Now, other than that, margin trading can be useful for diversification, as traders can open several positions with relatively small amounts of investment capital. Finally, having a margin account may make it easier for traders to open positions quickly without having to shift large sums of money into their accounts. Now, for all of its upsides, margin trading does have the obvious disadvantage of increasing and amplifying losses in the same way that it can increase gains. Unlike regular spot trading, margin trading introduces the possibility of losses that exceed a trader's initial investment and, as such, is considered a high-risk trading method. Depending on the amount of leverage involved in a trade, even a small drop in the market price may cause substantial losses for traders. And for this reason, it's important that investors who decide to utilize margin trading employ proper risk management strategies and make use of risk mitigation tools such as stop limit orders. Now, margin trading in the crypto market. Trading on margin is inherently riskier than regular trading, but when it comes to crypto, the risks are even higher. Owing to the high levels of volatility typical to these markets, cryptocurrency margin traders should be especially careful. Now, while hedging and risk management strategies may come in handy, margin trading is certainly not suitable for beginners. So it is highly recommended that moving forward, especially while you work your way through this course, you are trading via spot trading only. Now, spot trading is exactly what it says. You are trading without leverage, meaning you do not run the risk of liquidation should the price drop below a certain amount. Once we master spot trading, then we can consider moving into margin trading. Dollar cost averaging is an investment strategy that aims to reduce the impact of volatility on purchasing an asset. Now, it involves buying equal amounts of the asset at regular intervals. The premise is that by entering the market like this, the investment may not be as subject to the volatility as if it were a lump sum or a single payment. Now, how so? Well, buying at a regular interval can smooth out the average price, your average entry price. In the long term, such a strategy reduces the negative impact that a bad entry may have over your investment. Let's talk a little bit about how DCA works and how and why you might want to consider using it. Now, why dollar cost averaging? Well, the main benefit of dollar cost averaging, or DCA, is that it reduces the risk of making a bet at the wrong time. Market timing is among the hardest things to do when it comes to trading and investing. Often, even if the direction of a trade idea is correct, the timing might be off, which makes the entire trade incorrect. DCA helps mitigate this risk. If you divide your investment up into smaller chunks, you'll likely have better results than if you were investing the same amount of money in one large chunk. Making a purchase that's poorly timed is surprisingly easy, and it can lead to a less than ideal result. Now, what's more, you can eliminate some biases from your decision making using DCA, and once you commit to using this as a strategy, it will make the decisions for you. Now, dollar cost averaging, of course, doesn't completely mitigate risk. The idea is only to smooth the entry into the market so that the risk of bad timing is minimized. Now, DCA absolutely won't guarantee a successful investment, and other factors must be taken into consideration as well. Now, as we've discussed so far through Chapter 1, timing the market is extremely difficult. Even the biggest trading veterans struggle to accurately read the market at times. As such, if you have dollar cost averaged into a position, you might also need to consider your exit plan. That is, a trading strategy for getting out of your position. Now, if you've determined a target price or price range, that this can be fairly straightforward. You again divide up your investment into equal chunks and start selling them once the market is closing in on the target. This way you can mitigate the risk of not getting out of your position at the wrong time.
Dollar cost averaging is a more conservative approach to investing than simply spending all your money on securities at once. This technique allows investors to commit to a fixed dollar amount of a particular investment on a regular schedule, regardless of the share price. More shares will be bought when prices are lower, and fewer shares will be bought when prices are higher, resulting in a lower average cost per share. Dollar cost averaging reduces risks by allowing investors to ease into the market over time. For example, Chris buys $200 worth of stock in Billy Bob's restaurants each month for 4 months. In January, the value of the shares drops to $50 each, so he buys 4. In February, the stock is worth $40, so Chris buys 5. In March and April, he buys 8 shares of Billy Bob's, which dropped in price to $25. Overall, Chris purchased 25 shares at an average price of $32. If he had invested all of his money at the same time, then he would have only bought 16 for an average price of $50 per share.
You really need to understand how to manage your risk if you're going to be a profitable trader. And if you don't, you're likely heading down a one-way street to wrecked city. And we don't want to go there. So what is risk management? Well, we are constantly managing risk. We're managing it throughout our lives, either during simple tasks like driving a car or making new insurance or medical plans. In essence, risk management is all about assessing and reacting to risks. Now, most of us manage them unconsciously during everyday activities, but when it comes to financial markets and business administration, assessing risk is a crucial and very conscious practice. In economics, we may describe risk management as the framework that defines how a company or investor handles financial risks, now which are inherent to all kinds of business. For traders and investors, the framework may include the management of multiple asset classes, such as cryptos, or the management of many different cryptos and altcoins. There are many types of financial risks, which can be classified in various ways. In this lesson, we are going to discuss the way these are classified and also present some strategies to help you manage and mitigate your risk. Now, how does the risk management process work? Typically, the risk management process involves 5 simple steps: setting objectives, identifying risk, risk assessment, defining responses, and monitoring. Now, depending on the context, however, these steps may change significantly. So, step number 1, setting objectives. The first step is to define what are the main goals. It is often related to the risk tolerance of the company or individuals. In other words, how much risk are you willing to take to get towards your goals? The next step, identifying risks. The second step involves detecting and defining what the potential risks are. It aims to reveal all sorts of events that may cause negative effects. In the business environment, this step may also provide insightful information that isn't directly related to financial risks. a risk assessment. So after you've identified your risks, the next step is to evaluate their expected frequency and severity. The risks are then ranked in order of importance, which facilitates the creation or adoption of an appropriate response. All right, next step, defining that response. So the fourth step includes defining responses for each type of risk according to their level of importance. Now, it establishes what is the action to be taken in case of an unfavorable event. Monitoring. The final step of any risk management strategy is to monitor its efficiency to the response in events. Now, this often requires a continuous collection and analysis of data. Managing your financial risks. There are several reasons why a strategy or a trade setup may be unsuccessful. For example, a trader can lose money because the market moves against their futures contract position or because they get emotional and end up selling out of panic. Emotional reactions often cause traders to ignore or give up their initial strategy. This is particularly noticeable during bear markets and periods of capitulation. Now, in financial markets, most people agree that having a proper risk management strategy contributes drastically to their success. And I could not agree more. In practice, this could be as simple as setting a stop loss or take profit orders. Now, a robust trading strategy should provide a clear set of possible actions, meaning that traders can be more prepared to deal with all sorts of situations. As mentioned though, there are numerous ways of managing risk. Ideally, the strategy should be revised and adapted continuously. So here are a few examples of financial risks, along with a short description of how you can try to mitigate them. So market risk. This can be minimized by setting a stop loss order on each trade so that the positions are automatically closed before incurring larger losses. Liquidity risk. This can be mitigated by trading on high volume markets. Usually assets with a high market cap value tend to be more liquid. Credit risk. This can be reduced by trading through a trustworthy exchange so that the borrowers and lenders, or buyers and sellers, don't need to trust each other. Operational risk. Investors can mitigate operational risks by diversifying their portfolio, preventing exposure to a single project or company. They may also do some research to find companies that are less likely to experience operational malfunctions. And finally, systemic risk can also be reduced by portfolio diversification. But in this case, the diversification should involve projects with distinct proposals or companies from different industries, preferably the ones that present a very low correlation. Now, before opening a trading position or allocating capital to any portfolio, traders and investors should consider creating a risk management strategy. Still, it is important to keep in mind that financial risks cannot be completely avoided. Overall, risk management defines how to handle these risks, but it's certainly not only about mitigating risks. It also involves strategic thinking so that the unavoidable risks can be taken in the most efficient way possible. In other words, it is also about identifying, assessing, and monitoring risks according to the context and strategy. This process of managing risks aims to evaluate the risk-reward ratio so that the most favorable positions can be prioritized.
Risk management is the process of assessing, managing, and mitigating losses. This applies to both business and investing. Risk management exists in many forms throughout the financial world. An individual investor deciding to buy low-risk government securities instead of high-yield corporate bonds is an example of risk management. On the more complex side, it can involve trading in various types of derivative and futures securities to hedge against wide swings in investment portfolios. Companies and investors frequently use financial derivatives like options and futures, and strategies like portfolio and investment diversification in order to mitigate or effectively manage risk. Outside the financial world, risk management involves organizing and operating to reduce the potential for accidents, losses, and catastrophes. This can involve anything from managing risk of traveling abroad to designing safe building and products, as well as the most traditional form of risk management, purchasing insurance. Risk management also involves having a plan in place to get things back to normal as quickly as possible if something bad does happen. Marcy holds a high number of stock for Gobble Corp, GC, and wants to protect her investment from taking a loss. One option is for Marcy to enter into a futures contract that locks in the value of her Gobble Corp stock. This way, Marcy is able to manage the downside risk of Gobble Corp stock value by making sure she won't lose any value should the stock price fall. However, she will also be giving up any gain if the stock price goes up.
I don't know if it's breaking news to you yet, but technical analysis is hard. If you've been trading for at least a little while, or if you've been involved in cryptocurrency, you'll know that making mistakes is part of the game. In fact, losses are almost impossible to avoid for any trader, even the most experienced. Now, with that said, there are some trivial mistakes that almost every beginner makes when starting out. The best traders always remain open-minded, rational, and calm. They understand their game plan and they simply keep reading what the market is telling them. This is what you also need to do if you want to succeed. If you develop these qualities, you can manage risk, analyze your mistakes, play to your strength, and constantly keep improving. Try to be the calmest person in the room, especially when things are looking rough. Let's see how you can avoid some of these most obvious mistakes. Now, TA is one of the most used ways to analyze financial markets. We spoke in depth about this already. It can be applied to crypto, forex markets, and the gold market, and any other market really that you're looking to trade. And the basic concept of TA, it's relatively easy to grasp. It's a difficult art to master. When you're learning any new skill, it's natural to make a lot of mistakes on the way. This can be especially harmful when it comes to trading and or investing. If you are not careful and you're not learning from your mistakes, you risk losing a significant portion of your capital. Learning from your mistakes is great, but avoiding them as much as possible is much better. Now, this lesson, we're going to talk about some of the most common mistakes in technical analysis. And if you're new to trading, hopefully we can get you to avoid some of these as much as possible. All right. Mistake number one, not cutting your losses. Let's start with a quote from commodities trader Ed Secatora. Now, the elements of good trading are 1, cutting losses, 2, cutting losses, and 3, you guessed it, cutting losses. If you can follow these 3 rules, you may have a chance at being a successful trader. Now, this seems like a simple step, but it's always good to emphasize its importance. When it comes to trading and investing, protecting your capital should always be your number 1 priority. Starting out with trading can be a daunting undertaking. A solid approach to consider when you're starting out is the following. The first step isn't to win, it's not to lose. This is why it can be favorable to start with smaller position sizing or even risking real funds. I mean, you should be paper trading to prove that you can trade profitably before you start risking your own capital. Now, futures on Binance, for example, they do have a test net. ByBit does have a test net. You can sign up for these easily, and it's the best way to practice. Now, setting a stop loss is a simple rationality. Your trades should have an invalidation point. This is where you either bite the bullet or you let it ride. And I suggest letting it be the point where you bite the bullet and accept your trade idea was wrong. If you don't apply this mindset to your trading, you likely won't be doing it long enough to be able to learn if you can be successful. Even one bad trade can be very detrimental to your portfolio, and you might end up holding a losing bag hoping for the market to recover. Never trade on hope, never trade on emotion, never trade on feelings. Look at the chart. What does the chart tell you? Okay, number 2, and this is extremely important. Over trading. Now, when you're an active trader, It's a common mistake to think you always need to be in a trade. Trading involves a lot of analysis and a lot of, well, sitting around and patiently waiting. With some trading strategies, you may need to wait a long time to get a reliable signal to enter into a trade. Some traders may enter less than 3 trades per year and still produce outstanding returns. Let me say that again. Some traders may enter less than 3 trades per year and still produce outstanding results. Check out this quote from trader Jesse Livermore, one of the pioneers of day trading. He said, "Money is made by sitting, not trading." Try to avoid entering a trade just for the sake of it. I mean, you don't always have to be in a trade. In fact, in some market conditions, it's actually way more profitable to do nothing and wait for an opportunity to present itself. This way you preserve your capital and have it ready to deploy once the good trading opportunities come by again. Now, it's worth keeping in mind that the opportunities will always come back. You just have to wait for them. A similar trading mistake is an overemphasis on lower time frames. We've talked about this, and I'm sure I mentioned it to you in our one-on-one session. You need to spend your time on higher time frames. Analysis done on higher time frames will generally be much more reliable than analysis done on lower time frames. As such, low time frames will produce a lot of market noise and may tempt you to enter trades more often. While there are many successful scalpers and short-term profitable traders, trading on lower time frames usually brings a bad risk to reward ratio. As a risky trading strategy, it's certainly not recommended for beginners. Again, do not need to be in a trade all the time. Number 3, revenge trading. It's quite common to see traders trying to immediately make back a significant loss. This is what we call revenge trading. It doesn't matter if you want to be a technical analyst, a day trader, or a swing trader, avoiding emotional decisions is crucial. It's easy to stay calm when things are going well or even when you make small mistakes. But can you stay calm when things go completely wrong? Can you stick to your trading plan even when everyone else is panicking? Notice the word analysis in this technical analysis. Naturally, notice the word analysis and technical analysis. Now, naturally, this implies an analytical approach to the markets, right? So why would you want to make hasty, emotional decisions in such a framework? If you want to be if you want to be among the best traders, you should be able to stay calm even after the biggest mistakes. Avoid emotional decisions and focus on keeping a logical, analytical mindset. Now, trading immediately after suffering a big loss tends to lead to even more losses. As such, traders may not even trade at all for a period of time following a big loss. This way they can get a fresh start and get back to trading with a clear mind. Very important. Number 4, being too damn stubborn to change your mind. Now, if you'd like to become a successful trader, don't be afraid to change your mind. A lot. Now, market conditions can change really, really quickly. And one thing's a certainty. It's that market conditions are going to change and they will continue to change. Your job as a trader is to recognize those changes and adapt to them. One strategy that works really well in a specific market environment may not work well in another. Now, let's read what legendary trader Paul Tudor Jones had to say about his positions. He said, "Every day I assume every position I have is wrong. It's good to practice to try and take the other side of your arguments to see their potential weaknesses. In this way, your investment thesis and decisions can become more comprehensive." This also brings up another good point. Cognitive biases. Biases can heavily affect your trading decision-making, cloud your judgment, and limit the range of possibilities you are able to consider. Make sure to at least understand the cognitive biases that may affect your trading plans so you can mitigate their consequences more effectively. All right, number 5, ignoring extreme market conditions. Now, there are times when the predictive qualities of TA can become less reliable. These can be black swan events like what we saw in March of 2020, or other kinds of extreme market conditions that are heavily driven by emotion and mass psychology. Ultimately, the markets are driven by supply and demand, and there can be times when they are extremely imbalanced to one side. Take the example of the relative strength index, the RSI, a momentum indicator. Generally, if the reading is below 30, the charted asset may be considered oversold. Does this mean that it's an immediate trade signal when the RSI goes below 30? Absolutely not. It just means that the momentum of the market is currently dictated by the sellers. In other words, it just indicates that sellers are stronger than the buyers. The bears are stronger than the bulls. The RSI can reach extreme levels during extraordinary market conditions. We just saw that. We're actually seeing it right now with Bitcoin. The RSI on the weekly has pinned well above 90 for quite some time now. Now, even with the RSI at extreme levels, it might even drop to single digits, close to the lowest possible reading, even zero, near zero. Even such an extreme oversold reading may not necessarily mean that a reversal is imminent, and the same in reverse. If the RSI is pinned above 90 on the weekly, that doesn't necessarily mean that we are due for a reversal. Okay, so blindly making decisions based on technical tools, reaching extreme readings, can lose you a lot of money. And this is especially true during black swan events, as we mentioned, when the price action can be exceptionally hard to read. And during times like these, the markets can keep going in one direction or another, and no analytical tool will stop them. This is why it's always important to consider other factors as well and not rely on a single tool. All right, number 6, forgetting that technical analysis is a game of probabilities. Now, TA doesn't deal with absolutes. It deals with probabilities. This means that whatever technical approach you're basing your strategies on, there's never a guarantee that the market will behave as you expect. Maybe your analysis suggests that there's a very high probability that the market moving up or down, but that's still not a certainty, right? So it's either 50% here, 60% there, 70% would say in favor of, but there's still a 30% chance it could go against your idea. Now, you need to take this into account when you're setting up your trading strategies. No, it's never a great idea to think that the market will follow your analysis. If you do that, you're prone to oversizing your position and betting too big on one outcome and risking a big financial loss. All right, number 7, and this is very, very important and probably the most important one here. Blindly following other traders. Now, constantly improving your craft is essential if you want to master any skill, right? This is especially true when it comes to trading the financial markets, and in fact, changing market conditions make it a necessity. One of the best ways to learn is to follow experienced technical analysts and traders. However, if you'd like to become consistently good, you also need to find your own strengths and build on them. We can call this your edge, the thing that makes you different from others as a trader. Now, if you read many interviews with successful traders, surely notice that they all have seemingly different strategies. I mean, in fact, one strategy that works perfectly well for one trader may be deemed completely unfeasible by another. There are countless ways to profit off the markets. You just need to find which one suits your personality and trading style the best.